Hey guys, Dave with Moniology here. Happy New Year's Day. Today is January 1st, 2017, and this is the Moniology Year-End Market Review. For those of you new to our videos, we've been doing this for the better half of the second part of this year. We've got over 9,500 followers on StockTwits, and we're growing by leaps and bounds. We're very excited about what 2018 has in store for us. What we do is we like to approach videos from a weekly standpoint, remove some of the short-term noise in the markets, give us a better understanding of what's actually taking place without the noise. And it allows us to get a better perspective and then find the sectors that we want to trade and those that we want to avoid. Now this is going to be a little bit different. This is going to be a longer video. And the video is going to take a look at markets from a monthly perspective. We're going to look at various different sectors, various different charts. Some are related, others are not. And again, hopefully to give us a better perspective as to where we've been, where we are, and where we're likely headed. So without further ado, let's take a look at some of the most interesting sectors in the market today. So I want to just go through and look at the summary of one of my Google spreadsheets here that just oversees some of the markets here. So starting with the summary of the major sectors, we saw technology and the NASDAQ leading the major U.S. markets. Telecom, U.S. dollar, and energy were some of the major sectors that were very poor this year. When you take a look at the countries, and the countries were led by India, emerging markets, China, Hong Kong, Greece, all did exceptionally well. In fact, basically, you won't find any of the major markets that did really poorly aside from Russia, and even that was down just a couple percentage points. When you look at commodities, now commodities is interesting because that's a sector, as you'll see, that's really, in our opinion, is one of the better sectors to be in for 2018. That was led by lithium, palladium, aluminum, lead, copper. Some of the base metals did exceptionally well. We think 2018 will be the year of the precious metal. So that's an area that you want to be part of. And again, you look at these agricultural commodities, sugar, natural gas not being one, but coffee, grains, wheat, corn, etc. Those did really poorly this year. And finally, taking a look at fixed income space, foreign bonds did really well. 20-year treasuries did well. Emerging market bonds did fairly well. We think 2018 is going to be a year of pain for this particular sector, in large part due to the expected increase in inflation. Now, we have a watch list here of the 300 most popular ETFs or in various different sector classes. So just taking a look at very quickly which sectors did really, really well. China, technology, internet, got some lithium. India, China, social media, home construction, solar, China, real estate. So you see a theme. China has had a lot of really nice areas. You see Poland did really well in Europe, Austria. You got semiconductors. And then when you look at those that did poorly, again, sugar, natural gas, energy, MLPs. So a lot of these areas where, if you're contrarian, you want to be looking at these areas. If you're momentum, then you want to be looking at the ones that we saw here. But just very interesting perspective. This gives you a sense of kind of all the various different ETFs that we look at on a weekly basis to give us a better perspective on where we want to trade. Now, going into the various different charts that we have. Again, this is going to be a little bit long, so stay tuned. Houses sold, and this is in no particular order. This tracks from a monthly basis kind of what's going on in the overall health of the economy. Looks like houses sold are breaking out here to new multi-year highs, and that's a very positive sign for the economy. Housing starts, similar thing. It looks like it's breaking out of a range that we've seen where momentum was breaking lower, and yet price was heading higher, kind of diverging, but not anymore. Something just happened here where housing starts are breaking out, and that's a very positive development again for the economy. Producer price index, that's going to be a common theme. That's breaking out. It's been basically I don't want to say flat, but it's been very tame over the last couple of years. But something is happening right now in the last year in 2017 that's signaling that inflation is really starting to pick up. This is the price of various different commodities that we use on a day-to-day basis. It's starting to break higher, and that, my friends, is a sign that that inflation is around the corner, if not already here. Unemployment continues to break lower, which is again a positive sign for the economy, but I will point out that momentum is starting to diverge, and potentially this is something to look out for in terms of unemployment going forward. You got consumer sentiment. It's kind of flat here in a range in terms of momentum, but it is approaching. It's at the same levels today as it was in 2007, 2005. So if it breaks higher, that sounds to us like euphoria. Right now, it's still at very high levels, but nothing really to extrapolate from here. A couple of currencies of note. The Canadian dollar looks like it's ready to break out here, and that Canadian dollar is an economy. The Canadian economy is very tied to commodities. So again, the fact that this is getting ready to break out higher is very, very positive development for that commodity narrative that we're seeing. Now, Japanese yen as well. Japanese yen tends to do well when precious metals do well. This kind of looks to us like an inverted head and shoulders, and it's very possible that once this neckline breaks around that 95 level, that'll be that confirmation that things indeed are headed higher for precious metals. In Japanese yen, this is an ETF that does the same tracking. Now the U.S. dollar, this is a monthly chart since 2008, tracked by the UUP ETF, and you notice there was a breakdown here in basically the start of 2017, and it's very possible this is kind of the 90 level on the dollar. If this breaks lower, and we think it likely will, we're going to see probably a head down to about the 2250 level before we find some pretty strong support that we can probably bounce and potentially rally from there. But yeah, dollar weakness is what you want to see if you're a precious metal bull. And let's see what else we got here. So the 20-year Treasury bond ETF. So this is interesting because this particular ETF does well when the long-term Treasuries do poorly. It's inversely correlated. This kind of seems to us like it wants to head higher, which means that according to this instrument alone, long-term yields might be headed lower. That's interesting because we've been talking about the economy earlier, and on the one hand, the economy looks very strong. On the other hand, if long-term rates are going lower while short-term rates are higher, that's an inverted yield curve, and typically that's a sign that the economy may be headed into a recession. So not a guarantee, but definitely something you want to keep track of. But bottom line, on an absolute basis, this looks like it wants to head higher, which means long-term rates possibly headed lower. You got the biotech ETF, a very important sector in the markets. It broke down from this channel. It's created another channel here, uptrend. I mean, this could be viewed as a bear flag, but it looks like it's consolidating here. If it breaks out above the 90 level, expect to see a new leg higher in the biotech ETF. Here's another look with IBB. Yeah, it's kind of like an inverse head and shoulders here, creating a base. If it breaks out above that 115 level, say, that's a sign that indeed we're headed to a new leg higher in biotech. The BRIC ETF, this one it was creating a kind of a bearish wedge here for a while, and we thought we had a breakdown here, but on the other hand, it recaptured this wedge, and it looks like it's about to break to at least 10-year highs. RSI is very, very strong, and by the look of it, these BRIC countries are very tied to oil. Russia, Brazil, and not India and China per se, but they're doing well for their own respective reasons. But Brazil and Russia certainly oil tied, correlated to oil, and oil is looks like it's just starting its uptrend. China consumer, another area that we kind of pointed out earlier, has done exceptionally well in 2017, rallied from 10, basically almost 100% gain last year, and it's even though it had this correction here, it's possible. It looks like it wants to break above 19. If that happens, we're headed to new highs, another leg higher. China financials look very good. Is this a double top? We'll see. My hunch is we're headed higher here versus correction. China industrials look strong. They kind of pulled back here, found support, and look like they want to head higher. China large cap looks very good. Is this a double top? We'll find out. But my hunch is that we're going to break above this, and if that's the case, we're likely headed to this 57.40 level that we saw in 07. Now, Commodity Index Tracking Fund, DBC, this clearly shows you that, at least in the short run, the momentum gauge of RSI is suggesting that we've broken out and we are in a new uptrend in commodities. Now, the price has not yet followed suit, although this is kind of an ugly inverse head and shoulders pattern as well. You want to see this break above that 17-18 level, and that'll be your confirmation that indeed, from a price perspective, we are in an uptrend. But look at this. You've got the MACDs at basically 3-year highs, multi-year highs, and this is everything you want to see in a new uptrend, and I'm very confident that commodities have now begun an up move, and you want to start scaling in positions if you don't already own energy, precious metals, agriculture, etc. It's going to be a great place to be in. Consumer discretionary looks very good. It's breaking out above this wedge pattern, which is a very bullish development for consumer discretionary. Consumer staples don't look so good. And although we're breaking out to all-time highs here, we're creating this negative divergence, and that's a very, very negative sign from a monthly perspective. We broke below this wedge here, and now although we're consolidating, we're doing so on negative divergence. If we can't break above this RSI downtrend, that's going to be an ominous sign for this particular sector. Copper looks absolutely fantastic. Notice it broke out of two downtrends here, and it's created a massive new uptrend that's looks like it's only in the probably second or third inning. Oil, something else we pointed out, it looks like it wants to move much higher, and this is the OIL ETF, but the only resistance I see here is when we hit 50, but for the meantime, looks like there's some significant upside still in oil. Developed markets look very good. Dow Jones looks fantastic. I mean, looks like for 2018, looks like we're going to have another good year in the markets. Emerging markets look fantastic. It broke out of a multiple top range here since 2007, and this, we might consolidate here for a little while, but bottom line is emerging markets for the next 5 to 10 years are the equity asset class that you want to own. Now, taking a look at XLE, this looks to be a triple top breakout about to take place. Momentum is very strong. It's positive divergence here. We're testing that 60 level soon. Once that breaks, the next logical area on XLE is probably a retest of 77, followed by a move towards 90, 92. So XLE is definitely an area you want to be in. European financials look very good, and looks like it wants to break above that 70 area on the monthly RSI in the coming months ahead. That's a very positive development. Look at all this volume. It's definitely being accumulated, and as interest rates move higher, financials are definitely one of the areas you want to own. Financials here look very good, one of the strongest sectors. Taking a look at uranium, for those of you contrarian investors like myself, this is an area it's been basing for 2 years, and it's starting to break out. It's being led by momentum here. Momentum is at the same level, which is right above 50, as when price was at 19. We're only at 15 right now, and momentum is at the same level. That's very strong positive divergence, suggesting that we're going to break out above this level sooner rather than later, and when we do, there's going to be a lot of blue sky ahead. Precious metals, junior miners are still in this kind of triangle pattern here, but based on a number of factors, we think that when this breaks out, that's going to indicate a major up move ahead in precious metals. This is starting to break above 50, so stay tuned, and as MACDs start curling to break above 0. The majors in precious metals also are looking to break higher. Our trigger point is that 50 EMA around the 24.30 level. Looks like it's coming very, very soon. Gold, It retested this breakout from this downtrend since 2011 successfully, consolidated. Now we're firmly above the middle Bollinger Band on the weekly, and looks like we want to head higher on GLD. Solar ETF, it's done really well over the last couple of months, and I think it's just the beginning. Don't be surprised to see we're at 25. Don't be surprised to see 40 price level hit at some point this year. We're at multi-year highs on the MACDs, and there's no reason why this can't move higher. Junk continues to perform well, and but again, I'll point out this curve of the MACD is headed towards zero. If this cannot roll back above zero once it hits that level, that's a suggestion that this sector might be rolling over and that the economy might be in trouble. But what this also suggests is that we've been consolidating for a while. So let's see what happens. Is there going to be a leg higher, or is this just a rounded top? This is another look at high yield. You got the industrials looking very good. Industrials look like they're starting a new leg higher. It's one of the strongest levels sectors in the market. MACDs are breaking higher now. That suggests again that a new leg higher in the industrial space is taking place. Japan looks very good. There's nothing to say, but it looks like it wants to continue moving higher. MLPs are an area that is of interest because energy is doing really well, but MLPs have done very poorly over the last 12 months, but things might be starting to change. If you draw a trend line here, that suggests that the downtrend in MLPs of 2017 has likely ended, and as you see the volume picking up, this could be a really good time to get into this space. Taking a look at momentum. Well, this says it all, guys. Momentum has been absolutely crazy. That 2017 has been the year of momentum, and it doesn't look like it's stopping anytime soon. NASDAQ looking very, very good. Another sector that you want to really look at is natural gas. It broke out of a long-term downtrend. Now it's been consolidating above this breakout zone, and now the volume's starting to pick up. And I would not be surprised, unless we have a total breakdown here, that we're going to start moving back up in natural gas. So definitely what you want to keep an eye out for. Palladium looks good. Real estate, another area. This chart kind of looks to us like the 20-year Treasury. It's very interesting what the correlation is to these. But real estate looks good. It looks like it wants to start moving higher soon. So another leg higher in real estate likely in 2018. Here's the REIT VNQ ETF. It's been consolidating here above the middle Bollinger Band as the MACDs are starting to curl higher. Real estate is an area you want to be potentially buying as the economy continues to strengthen. Russell 2000 looks really good. The Russell Growth ETF looks like it wants to break out to a new high and set up another leg higher. Russell Value looks strong. S&P 500 goes without saying. It looks like it wants to break out here and make another high. So bottom line, in terms of the major market indices, they look very good. S&P Home Builders looks like it wants to break out here. Again, Steel ETF is making a new leg higher here. This is a very powerful candle with conviction. Hammer pattern looks like we want to head towards that 60 level on Steel ETF. Technology looks fantastic, very strong. Transportations, Dow Transports are look strong, but I will point out there is a divergence here. We're in a bearish wedge, and although we're at all-time highs, momentum is not as strong here as it was in 2014. So something to definitely be aware of. Treasury bonds, the 3 to 7 year ETF, the momentum is waning here, and I would say that rates are likely moving higher, and this particular ETF is likely moving lower. 7 to 10 year treasuries, again, they're finding some support here on the 50 weekly RSI, but likely headed lower as interest rates head towards $3. Home construction looks very strong, and it looks like it's building another leg higher. This is the inverse of TLT that we saw earlier. This one looks like It's still breaking down. I mean, you could potentially say that this is a bullish flag here. So I'm watching this very closely to determine kind of what's taking place in the longer term treasury markets. Airlines, now they're making all-time highs, but they're creating negative divergence. So I want to see what happens here at this 125 level. Do we break out higher and move towards the multi-year highs of 180, 190, 210, or do we start rolling over here? I can't say for sure, but momentum is not necessarily leading the charge here. Baltic Index, it's kind of had a nice run since 2016, but this was a very ugly pattern here. So we'll see what happens in the start of 2017. Is this an anomaly, and are we moving higher, or is it indeed starting to roll over as we close below 60 on the month? All right, so a couple of the indices that we saw the ETFs for. The Dow looks fantastic. Transports look great. They're breaking out of a downtrend here, and so transports are leading the Dow. Dow utilities are kind of rolling over here, which is a suggestion again that interest rates are likely moving higher. The Euronext 100 index is kind of consolidating, but there's no reason to assume that this is not going to be making another break higher. It's had trouble breaking above the 70 level, which is on the same area that we kind of broke down from over here and over here in 2007. So that serves as resistance. If we can break above that, that's a good sign. If we can't break above it, we break below 60, that's a sign that potentially Europe is starting a correction. Now you've got gold. Gold is looking very good. One of our major 2018 highlights is that gold will be breaking this 1380 zone, likely moving towards 1600 for 2018. Definitely a 5-star index that you want to own for this year. You've got the Gold Bugs Index. It's had a nice hammer pattern when people thought gold was headed lower. Nope. Had a shakeout here below this triangle and now moving back higher. You want to see this break above this trend line to confirm that my view is indeed accurate, but for the time being, RSI has already broken this downtrend, consolidating above it, and it looks like it wants to move much higher. Crude oil monthly, we've pointed this out for a while. 60 area is really basically the neckline of an inverse head and shoulders. Our first price target in 2018 is 70, followed by 80 before we think we're going to see some pretty strong resistance. Platinum is another area like gold. We think that this is going to break out and likely tag 1200 at some point this year. So a lot of upside in platinum. You got the Shanghai Composite. Looks like it wants to break higher here from this kind of descending bullish wedge pattern or bullish triangle here. So China is looking good. Where do we go here? South Africa looks very, very strong. It looks like it wants to, with momentum leading the charge, looks like it wants to break multi-year high of around 77 and likely breaking to all-time highs in the South African index. Next is Tokyo. Tokyo looks very, very strong here. Then you've got the Canadian Composite here, led by commodities. It's breaking out of multi-year highs to multi-year highs. That's a very positive development, again, for commodities, for the Canadian economy. So those of you in Canada, things look very bright in 2018. VIX still in a downtrend, but it's the momentum downtrend seems to have been broken. So we'll see if in 2008 you notice the MACDs are continuing to curl here. If this breaks above, maybe we'll see our first correction 10 to 15% in 2018. Let's look at the world stocks. They're breaking out in both momentum as well as price. This is a very, very strong breakout. Next target is 2220, followed by about 2400 on the MSWORLD index. Now let's take a look at some rates. I mentioned inflation, that's a common theme. Well, this is what's happening in 10-year rates around the world. Germany has broken out of its downtrend, consolidating I expect this to break higher in the not too distant future. It's a sign that inflation is moving. Now you want to see German yield versus the U.S. Treasury yield. Again, Europe is growing faster than the U.S. right now based on all the monetary stimulus, and we see it here that the German yield is likely to exceed the 10-year Treasury. Now you've got the Japanese yield. Japanese yield has been in a downtrend since forever. Now it's looks like it's about to break above this downtrend. Again, that's a very bullish sign for inflation. The UK yield. It's still in a downtrend, but looks like it's getting ready to break higher. So we'll see what happens in the UK. Now you got the 10-year Treasury. We already broke this downtrend here since 2009. Now the question is, do we break above this downtrend since forever, since 1995? Well, it needs to break above this 340 level. I don't know if we'll do it, but if we do, you want to definitely keep an eye out for this. But we will tag this line, in our humble opinion, in 2018, and there's going to be a big panic in fixed income, and then what happens, we'll find out. But interest rates are moving higher to economy near you. Here's another look at the 10-year Treasury yield based on the TNX. So this is since 95, basically the same chart, kind of different graphic here. Anyway, looks like it wants to break out here, and then again the next target is 30. Now a couple ratio charts to end this video with. S&P versus the global index. S&P is breaking down against the global index. That's a good sign for global growth. Bad sign if you wanna own the S&P exclusively. You want to own and a diversified index, but global growth is accelerating. Here's another SPX versus MSWORLD. We had this massive outperformance of the U.S. and that's changing here. So stay tuned for that. Then you've got the 20-year Treasury versus the S&P. The 20-year Treasury outperforms the S&P during poor economic cycles. So far, there's no sign to suggest that things are starting to weaken in the economy here based on this chart alone. Bonds are underperforming the S&P, and they're breaking down to levels not even seen before 2007. You got the 20-year Treasury versus the TIPS. Well, if the 20-year Treasury is outperforming the TIPS, suggesting potentially a downturn in the economy, well, it's been in an uptrend since 2010. Basically, inflation has not been here, but now we're just tagging this lower boundary here, and so it remains to be seen what happens on the 20-year Treasuries versus inflation. If you look at the TIPS in an absolute level, they look ready to break out right now. So this, I don't know what to make of this, to be honest with you. You've got the consumer discretionary sector versus consumer staples. That looks very strong, and it suggests that the economy is strong, and people are looking to spend money a lot more than in some of these consumer staple names, which are more for poor economic times. Developed markets versus the S&P, well, they're starting to break higher, and that's being led by momentum, and again, a good sign for the overall global economy. Here's another view of the emerging markets versus the S&P. Been in a downtrend since 2011. We've been basing for 2 years, and now we're starting to break out higher. A lot of upside ahead for emerging markets versus the S&P. Taking a look at gold versus copper. Again, another one of those inflation charts. Gold cup and handle here, and looks like it's found support here, right as we expected it to. And I want to see this breakout higher, and I think it will. So we broke out from a momentum perspective. We've retested it multiple times, and you want to see this now turn higher and head north. So we'll see if gold can outperform copper. Finally, a couple more pages here. Gold versus the S&P. Again, I think that gold is starting to, it's been basing against the S&P for a couple of years now. will it head higher in 2018? We think so. So definitely a ratio chart that you want to be aware of. Gold versus SPY, GLD versus SPY. So far, nothing to see. We've been breaking down, but the RSI is curling higher, and this trend might actually be reversing very soon. High yield bond versus the 20-year Treasury ETF. When the high yield bonds outperform 20-year Treasuries, it's a sign of a economy that's continuing to strengthen. It's not happening right here, and that's very important. Is this just correcting here, and then reverse higher, or is this the beginning of a breakdown here? And so this is one of the most important charts in this particular video. Here's another investment grade versus high yield. You want high yield to outperform investment grade, but that's not happening here as well. High yield or investment grade is starting to rally against high yield, and suggesting that this rally is just beginning. And if that's the case, again, another sign, check mark, that maybe things are not as good as they seem in the economy. You got the miners, the junior miners against the majors starting to pick up. They broke out in 2016, have been consolidating here. It looks like it's ready to break higher. So the juniors against the majors, we see this also in silver, are suggesting that, again, precious metals are just starting their uptrend. You want to see platinum outperform gold in any legitimate uptrend. It kind of double bottomed this ratio, but with positive divergence. That's a very positive sign. You want to see, here's the platinum versus gold chart since 2008. Platinum has been completely killed, but perhaps this downtrend is ending. We'll see. You want to see precious metals against the base metals. Looks like they kind of double bottomed here, and it looks like it's going to break this descending wedge. It's a bullish pattern here. If it breaks, that's another sign that indeed inflation is here. Russell versus the S&P. Well, nothing really to see here. Nothing really to see here. Nothing really to see here. You've got the S&P outperforming the 7 to 10-year Treasury. Nothing really to see here. S&P is kind of rolling over against another one of those world indices. Here's another view, S&P versus emerging markets. S&P versus the bonds. We broke out in 2016 and we haven't looked back. Now we're kind of at a double top zone here. What's going to happen with the S&P versus the long-term bonds? Are we going to turn back lower here and break this uptrend? Or are we going to break out here and see another move higher in equities in relation to bonds? We shall see. And silver versus gold. You want to see silver outperform gold in any legitimate uptrend in the markets, and it looks like that's started. We've broke out the initial downtrend here in 2016. Now we kind of consolidated. We're about to break out. You want to own silver. If you had to choose between silver and gold, based on this chart alone, silver is the metal that you want to own, and silver miners are the metal you want to own versus gold miners going forward if this particular breakout is indeed taking place. So bottom line, guys, the theme of 2018 is inflation. Inflation is here. Precious metals strong, dollar weak. That means anything that's tied to names that can raise prices, that's real estate, that's construction, that's consumer discretionary, those areas are, and in financials, those areas are going to continue to do well. Consumer staples, utilities, any names that are tied to that have been very strong in a low interest rate environment, that's going to be weak in 2018. Bottom line is, thank you so much for your support. If you haven't followed us already, please do so on StockTwits and on Twitter. And you can support our work on Patreon. There's a link in the show notes you'll find there. And good luck in 2018. Thanks, guys.